to our interview series where we bring you valuable insights from top fund managers across leading AMCs. Joining me and my colleague Chirag today is Harshad Borawake. He's Head of Research and Fund Manager at Mirae Asset Investment Managers. Welcome, Harshad.
Sure. Thank you, Ruchira, and thank you, Chirag, for giving me this opportunity.
Good to have you here. Now, beginning with our first question, you started with a BE in Polymer Engineering. So what drew you to equity investing?
See, I always wanted to go into the management side, and at the same time, I was also fascinated by the stock markets. So in this context, I pursued my MBA in finance. And during MBA, frankly, I got introduced to equity research as a profile, and also one of our professors, used to discuss markets mainly after the classes. So obviously, try to read more about it. Read some books like One Up Upon Wall Street by Peter Lynch. Tried to complete The Intelligent Investor by Benjamin Graham, but obviously it was much tougher at that point in time. Also, I did some summer internship at a local, broker in Pune. So thankfully, also allowed me to do equity research rather than doing some client calling. And yes, I think that at the campus also I tried to get more job on the equity research side, which eventually worked out. And first job was on the equity research, and then obviously after that progressed, through the years. Yeah.
Now, Harshad, you have been on the both side, on the sales side as well as on the fund management side in the current juncture. How has this role shaped your investment approach?
I think the sell side, I have been on the sell side for more than 10 years or so, almost 10 years. So sell side was more about in-depth research in particular sectors or few sectors which I was tracking, analyzing more, and plus it was also important to articulate the views to the clients, so that I can help them get more insights in particular company or sector, and most important, the insights had to lead to some actionable or decisions either to buy or sell. But I think on the buy side, it's more different. Here, it's more about taking bird's eye view. We have to look across the sectors and not just one sector. It's more like joining the dots. So, for example, let's say commodity prices rising. So it can benefit the commodity producers, but can be negative for the users. Or for, let's say, right now we are going through the interest rates might go down, so it might be positive for few banks, negative for few banks, positive for NBFCs. So you have to join the dots more on the buy side. So here it's buy side, it's more about multiple factors one needs to look at. And when it comes to investment strategy, obviously it starts with the mandate what we have for the fund. To the extent possible, we try to do bottom up stock picking. Obviously, one has to keep cognizance of the benchmark. So I think to answer your question, sell side was more in depth, and buy side is more about taking view across the sectors. And from the portfolio, we have to look multiple things and not just one or two things. Yeah.
Sir, how would you describe your investment philosophy, and how has it been evolved with the changing market conditions?
See, I think during my career, frankly, I have seen started with global financial crisis. Then you had QE, QT, then multiple government changes of late, COVID. So I think throughout the years or throughout what I have learned is, obviously one has to keep eye on what's happening on the macro front, on the global front. But I think the bottom line is, it's more about the company you invest into, what you have to more focus on, whether the company what you're investing into, whether it can grow reasonably over the years, what modes does it have, what kind of ROCs it can generate. So frankly, what I've seen, the cash flow generation is more important than what's happening on the macro front. So what I frankly focus more on, let's say ROCs at least has to be 15% pre-tax. Or the management quality has to be much better. And eventually when it comes to valuation, so again it's not while the company might be good, but I don't typically buy at any price. It has to be up to a reasonable price. So what we call it, what typically people say that growth at reasonable price. So GARP, I think that's the philosophy. So over the years, I think the lesson, what I would say is, don't give too much importance to the near-term factors or sentiments. Focus more on the company which you are investing into. As long as you are comfortable on the company and the outlook, I think you should be fine.
All right. Can you also share with us how does your research expertise influence your fund management decisions?
So I think see, fund management, while it's more about portfolio management. It's more about trying to assess risk reward. But I think the bottom line is even if fund it's made up of different stocks. So there, what is more important is any stock which you buy or any stock which is part of a portfolio. So there you have to do in-depth research. There is no excuse to that. You have to do more ground research. See, it is more important when the markets are volatile. The convictions, conviction what you have in a stock is more tested when either the stock's correct or when the stocks really moves up at that point in time with the decision to sell it or hold it. So I think research expertise is more about taking a decision when it is more critical. The focus on a day-to-day basis, the focus is more to the extent possible, try to reassess the portfolio companies what we have. But I think obviously what also happens is that it's difficult to time cyclical sector. So there are some biases, which come into the cyclical sectors. But other than that, the focus is more about assessing what's in the price. It's not about company is good or not bad. But what is more important, whether what's in the price. So for example, let's a sector like FMCG, where the ROEs could be upwards of 80 or 100%. But the point is, the value which you are paying, if it is much higher, then it really doesn't make sense. Yeah.
So, over the past couple of years, several flagship Mirae equity funds, including large and mid-cap, ELSS, and mid-cap, so they have faced challenges with with many ranking in the third and fourth quartiles in 2024. So there we wanted to know two things. Firstly, what have been the key hurdles? And secondly, how do you plan to steer these funds back to their winning ways?
So I think the nature of the market, if you look at particularly last 2-3 years, so let's start with what worked and what didn't work. So what worked was clearly the, let's say, PSU names, more so within that industrials like defense, railways, the stocks which really didn't do anything for the last 8-10 years. So they suddenly start moving up and moved up sharply, moved up multiple times. So if you look at our investment framework, typically, we don't invest in a company, or I think if you are to invest anything in India, it really doesn't make sense, to let's say ROEs, ROCs are in a single digit or so. So I think at Mirae, I think what we missed more on this PSU, few of the PSU names which really did well, and some of our peers obviously had those, and we didn't have. Did we change our strategy post this? I think, see, frankly, we are sticking to our fundamentals. We are sticking to invest into the quality names. Particularly if you look at last 3 to 6 months, for example, let's say hybrid portfolio, which I co-manage, I think things are getting normalized. I think markets are also getting normalized over the last few quarters. So in terms of ranking, I think we are seeing, obviously it will take some time, but we are seeing some improvement in the last few months. On the other hand, also, some of the stocks which we bought, let's say error of commission, I would say. So some of the names didn't do well. So obviously we believe that it's more of a transitional setback over the period. They should, do well.
Okay.
Sir, now coming to the equity markets, after the recent correction, do you think the Indian equity markets are more attractive, or is there room for more correction going forward?
I think, markets have fallen, let's say, depending on which index we are talking, anywhere between, let's say, 12 to 15% at a headline level. At a stock level, I think corrections are steep wherever there was growth. So, for example, the sectors which we missed, like defense and all. So there we have seen corrections of upwards of 30 or 40% or so. After the correction, I think still markets are not yet cheap, according to me. Obviously, they are much better than what they were 6 months back. So if we look at broader indices, let's say Nifty 50, now on a FY27 basis, they are available at less than 17 times forward earnings. It is lesser than the 10-year average, but at the same time, I think mid cap and small cap still trade at a premium to long-term averages. So markets, I think, have not really become attractive, but are in a much better shape than what they were 6 months back. Within that, I think large cap makes a lot of sense from the medium-term perspective. One of the other thing I think, which I think markets can, should do okay is we are seeing some green shoots on the rural side. See why markets fail. One of the few reasons, if I can point out, there is a consumption slowdown. Then because of election, we saw, government capex kind of getting stalled in the last few months. And obviously in the global front, there is geopolitics, and then it exacerbated with, FI selling. So within that, I think domestic factors, hopefully should get addressed post the recent budget, where government has given meaningful concessions on the taxation front. So consumption part, I think, should get addressed. Rural, as I said, we are already seeing some green shoots. What was absent in the last few years was private capex. I think government was the only one, which was doing capex. So hopefully over the next 2-3 quarters, we do see, private capex coming back. I think that should again lead to, markets doing well. From the earnings point of view, if you think at, let's say, Nifty 50, right? So when we started the year, we thought Nifty 50 earnings will grow at, let's say, anywhere between 14 to 15%. But now, for the third quarter results, FY25 earnings growth is, around single digit 5% or so. But FY26, 27 numbers are, still very much, I would say, resilient. Look, we are looking at 14 to 15% earnings growth. So I think in that context, with Nifty 50 available at less than 17 times, we should be largely okay, barring any major other geopolitical global issues.
Sir, you spoke about the large cap being attractive and small and mid cap still, not being at the historical average. So do you see more pain or more correction in the small and mid cap segment? How do you look at it? This both of the segments.
See, I think I would say large part of froth has gone away, but does it make mid and small as a basket attractive? I think answer is no, according to me. See, last few years, it was all the stocks, kind of did well. Market breadth was quite good. But incrementally, I think now we have to go back to basics. It's more about stock specific. Incrementally, even both mid and small, I think unless, the company, what we are investing into, unless, the company has decent ROCE, company has, decent balance sheet, valuations are reasonable, then only it would make sense. Otherwise, I think the blanket investing or basket investing may not, work incrementally in the mid and small. I think we have to go back to bottom-up stock investing in there, out there.
All right. Now, with foreign portfolio investor outflows and weaker earnings, what do you think can drive a market recovery?
I think, see, this budget, which happened, so clearly there was a change. Government did listen to the pain on the ground. So clearly there was a change from capex to consumption. So hopefully that should help drive. So again, it will take some time. It will not happen overnight. So I think the consumption weakness we are seeing in the last 2 quarters, particularly urban, right? So there, I think we should see some comeback. 2 quarters down the line, see on the urban side, one of the issue was also of this impact of inflation, more so on the masses side. So I think over the next 2-3 quarters down the line, we do believe that the impact of inflation should moderate. So to that extent, things should be okay. Secondly, I think if you look at the breadth of corporates, so let's look at different sectors. Let's say starting with on the consumption side, let's say retail, QSR. On the investment side, let's say cap goods or infra companies, or on the global side, let's say pharma or let's say metals. So earnings growth wise, I would say there are multiple sectors which are driving the earnings growth. It's not one sector. Within that, if you look at banking, yes, the credit growth has come down, but I think it is still in the double digit. So multiplying, marrying all these factors, I think there are multiple sectors which are driving the earning growth. From the market's point of view, I do believe that there should be some time correction which could happen. But as and when the earnings catch up happens, we should again see, markets, doing well. And I think just to just put in context, I think the market returns in the last 3-4 years also were quite phenomenal. So we also have to keep that into mind when so the last 10-12% correction, I think it's more healthy, much needed correction, I would say.
Sir, coming to specific to the funds you manage few hybrids funds and one balance advantage fund. Is it any way different than the pure equity fund which is managed by the fund house, or is it the same strategy to adopt in the hybrid structure as well as in the pure equity funds?
See, hybrid, as you know, consists of different asset classes. You have equity, you have debt, and in some you also have commodity. Also, coming to the managing of hybrid fund, the equity portion management is similar to any other pure equity fund. In our funds, what we do is that given the typical investor profile which comes into hybrid funds, so we have by choice kept all our hybrid funds, large cap biased. But I think the equity portion is similar to any other flexi cap fund, so no difference in that. The only difference in the hybrid fund is, there is an added layer of deciding the allocation between the different asset classes. So we have 4 hybrid funds, starting with equity savings, where equity could be, let's say, anywhere between 35 to 45. On the other extreme, we have aggressive hybrid, where we keep equity, let's say, anywhere between 67, 68 to 75, 76. And within that, we have 2 other funds, which is balance advantage and multi-asset allocation, where the equity portion is quite dynamic. It can move from as low as 30% to as high as also 75, 80%. I think to answer your question, it's no different when it comes to the equity part, but there is added layer in terms of how much equity we need to keep, or how much debt and how much commodity we need to keep. So that's a added, I would say, decision making which we have to do. But coming to returns of hybrid fund, it is combination of 2 factors. One is what is asset allocation, and secondly, what you have bought within that equity portfolio.
Coming specifically to Mirae Asset Hybrid Equity Fund, it initially had a strong lead over its peers and benchmark, but its margin of outperformance has gradually declined, as seen in 5-year rolling returns. So what factors do you think have contributed to this dip in performance?
Sure, I think, if you look at again last 3 years particularly, what did well in the market was, mid cap and small cap names. And on the broader side, let's say industrial names like defense or so. So as I said, at Mirae Asset, so by choice, we have our portfolio allocation towards large cap biased. So I think in that context, there is underperformance in this period when mid and small cap did really well. But if I had to look at last 3 to 9 months, I think again funds are doing quite okay. We are now slightly moving. In 3 months, I think already we have moved to from Q3 to Q2. But yes, what has not worked is because of our large cap bias. I think that has harmed the relative performance, I would say.
Sir, you even going forward, you plan to run the fund in a similar way, having a large cap bias?
See, the point is, what we believe is that people who come to the hybrid funds, so typically, they could be the first time investors, or typically they want returns more than FD, but at the same time, they don't want to take volatility risk, which typically, is in the equity funds. In that context, we will give a large cap bias. But having said that, when I say large cap bias, it doesn't mean we go to 80-90%. So what we say is that typically I would have at least minimum 60 to 65% in large cap. Now, obviously, it is upwards of 73, 74. And then remaining is mid and small. So large cap bias, it means, the higher portion, but not to the extent of 80-90%. But yes, we'll not change our strategies. See, frankly, I think again, we'll stick to quality names, not really chase frothy or momentum name. But obviously, at some point in time, if required, we do take hard decisions in case something goes wrong in terms of our stock selection.
Sir, you spoke about it, but could you just elaborate more on the performance has improved, as you mentioned, from quarter 3 to quartile 2. But any further steps to improve the performance of this fund, because it's one of the biggest funds in the category?
But I think what we observed, when we do our attribution analysis, so it was not that we didn't have the stocks which have done well. But I think the allocation or the weights, I think, had made a difference. So, for example, we should have had higher weights where we have high conviction. In the last 1 year, we already, I think, taken some corrective measures in the sense wherever we have higher conviction, we have slightly increased the weights. And I think that the benefit of that is already seen, as I said, in the last 3 to 9 months. So we have not changed our stock selection process, but I think we have slightly modified, we're slightly allocating higher weights, where we have higher conviction.
Mirae Asset Midcap Fund, it now has about 15,000 crore rupees in AUM. So making it one of the top 10 midcap funds by size. So at what AUM threshold do you think would Mirae Asset start feeling uncomfortable about managing its performance effectively?
While that fund is managed by my colleague, but I think, see, if you look at midcap as a category, the bigger funds are upwards of, if I'm not wrong, 50-60,000 crores also. In that context, I think 15,000, I think, is very much manageable. So I think the other important point, the depth of market in the last 5 years has increased a lot. So, for example, let's say 5 years back, the let's say lowest large cap now is 1 lakh crore. So mid cap category starts at 1 lakh crore. So to that extent, I think the depth of the market has increased quite a lot. So 15,000 crores. I'm not sure. I can't give a number because I've not studied, but I think maybe even additional 25, 30, 40%, AUM on over and above what we have now should not be much of a issue.
Sir, you spoke about how the depth has increased in the market. So, being the head of research, how is the stock universe changed at Mirae Asset MF in the past few years? Has it seen the increase in number of the stocks added to the universe? Could you just elaborate that on that particular thing?
See, I think around 3-4 years back, so let's say 4 years back, the number of stocks my team used to cover was roughly around 400, 450 names. So we had around 8-9 member team at that point in time. So over the period, obviously, as new listings happened, as fund size grow. So what we have done is that the number of stocks under coverage now has moved up to almost 650 names. Our team size has doubled. So to that extent, we have made investments on the team. And if you look at our portfolio names, so let's say 5 years back, Mirae, as a whole, we used to hold, let's say, around 110, 15 names across the strategies. Now that number has moved to almost 170, 75 names. So yes, as market depth has increased, we also invested in our own research process.
Okay. And sir, before we wrap up this chat, the last one, new age businesses continue to have small and steady allocation across the Mirae Asset funds. What factors influence their inclusion or exclusion in the portfolios?
So for the new age, I think it boils down to unit economics. So as long as I think we are comfortable with the unit economics of that company, I think it might it can come in the portfolio. And I think what has changed in the last 2-3 years, particularly for the new age, is that all the companies, particularly after when they get listed or in and around that, so everybody has started to focus on profitability. Focus shifted from top line to bottom line. So that has worked well, for the listed space also. So I think wherever we are comfortable on the unit economics, I think we have allocated. It's not a big percentage, but small percentage within the portfolio.
All right, with that, it's time for us to wrap up this chat. Thank you, Harshad, for taking time for this interaction. It was good speaking to you.
Sure. Thank you, Ruchira. Thank you, Chirag.